Hi, this is Bennett Tchaikovsky, and welcome to Inventory Lower of Cost or Market. This is a video that is geared for those of you that are taking intermediate accounting. So my disclaimer and copyright notice, the information and opinions in this presentation are those of the author only and not the author's employers or affiliated organizations, including but not limited to Irvine Valley College, the South Orange County Community College District, or Chapman University. The presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. The presentation is copyright 2008 to 2019 by Bennett Tchaikovsky. I encourage you to share this presentation and share links to this presentation on an unmodified basis. If you modify the presentation in any way, please email me prior to doing so at 1812cpa@gmail.com to discuss. Note, the author does not claim any copyright whatsoever in any companies or organizations mentioned in this presentation. Rather, the other parties are the owners of their respective copyrights. Okay, so for intermediate accounting, and this comes over here from the accounting coach, and I'll kind of put this over here in the video description, is that when we're determining market, right, when we say lower of cost or market, what that's really going through and referring to is, okay, what is market? It's going to be the middle of these three values. It's going to be replacement costs, net realizable value, or net realizable value minus a normal profit margin. What exactly is net realizable value? Okay, so the net realizable value is the selling price of the inventory less any kind of cost to sell, complete, or dispose. And a normal profit margin is what the profit margin the company expects to sell in terms of doing its inventory. Now, when you see this in terms of, they'll say, oh, this is the ceiling and this is the floor. Yeah, okay. If you treat this, if you compute the three values and figure out the middle, that's going to be your market, and you'll kind of satisfy all those things, because no matter what, this replacement cost is going to be falling in between one of those areas right over here. So that's going to be helping you going through and determine what exactly is your market. So what I've done here is I've modified the question that we went through and did for the other video. So the concepts are really the same between how I would teach this in financial versus intermediate, with the sole exception of being how we compute market. So in a basic financial accounting class, I would be giving you market. Over here, I'm basically having you compute the market value. So let's go through and do that. So here I've given some additional information. So let's go over here to our Google Sheets. I'm going to pause real quick while I pull that up. The other thing I've changed on this video is that my total cost of goods sold, I've changed that from 10 million to 50 million, just so the differences will be a little bit more apparent when we're trying to go through and determine what exactly our adjustment is going to be. Okay, so before we go through and determine what exactly is our market, we've got a little bit of a different thing here. The market value is going to be the middle of three different values, which is going to be, we'll call this over here. We're going to move this around a little bit. So what I'm trying to figure out here, hold on. Okay, so Gray, are we going to make an appearance today? Do you want to kind of oh, there we go. So we've got a cat attack right now. We have got a kitten who wants to be a YouTube star. I'm going to go shoot like a little bit of video right here. So hello there. This is my cat looking for. There we go. We've officially gone for the cat to make this even more exciting. Cat is showing me my belly. Am purring, which according to most YouTube videos, which means I'm actually in pretty good shape. So we're going to go ahead and pause that. Okay, so what we need to figure out is market. Okay, and before it was given to us, this is going to be a little bit different. So when I'm determining market value, it's going to be the middle of the replacement cost. Then over here, what this is going to be, so it's replacement cost, and then we're going to have per unit net realizable value, and then per unit, this is going to be net realizable value minus a normal profit. Okay, so how do we figure out the net realizable value? Okay, if I call this, okay, so right over here. So my per unit net realizable value is going to be my selling price minus my per unit completion cost. So right over here, this over here is 30 minus 5 or 25. This here is 30 minus 3, 34 minus 3 or 31. I've got 32 minus 2 or 30, 35 minus 4 or 31, 15 minus 6 or 9, and then 40 minus 1 or 39. Again, why am I going through and doing this? The reason is that I need to use the lower of cost or market. So even before I can figure out if my inventory is at the lower of cost or market, I need to figure out what exactly is my market value, basically what is market. So what I'm going to do is I'm comparing this right over here. I'm trying to figure out what is the middle value. So the first one for market is replacement cost. The second one here is net realizable value. Now the third one is going to be the net realizable value, which I just computed, minus the normal profit margin. So over here, I'm going to take this net realizable value, or this 25, minus the 10, or $15, okay? Over here, this is going to be 31 minus the 8. And over here, this is going to be the 30 minus the 6. Over here, this is going to be the 31 minus the 7. Over here, this is going to be 9 less the 3. And then over here, this is going to be 39 minus 15. Okay, so generally, the replacement cost and then the per unit selling price, per unit completion cost, per unit profit margin, these will be given to you. However, for this kind of question, you're going to need to figure out what is this per unit net realizable value, and then what is the net realizable value minus the normal profit margin. So now what I'm going to do is I'm going to focus on these three areas right here. Okay, so I'm focusing on these three right here. And what I'm trying to say is, what is the middle value? Okay, so here the middle value is going to be replacement cost. Okay, or right here. Okay, here my middle value is going to be 31. Here my middle value of 23, 30, and 24 will be 24. Here my middle value of 25, 31, and 24 will be 25. Here my middle value is 9, and then here my middle value is going to be 30. Now note, one of the things we saw was that they always say, okay, your market can never be higher than the net realizable value. Also, your market can never be lower than the normal profit margin. So as we see this right over here, like in this here, oh yeah, well, we're doing it in RV, and that means we're keeping in line with that statement. Over here, lowest it can go is net realizable value minus the normal profit margin. And then over here, you know, again, we're over here at net realizable value. So that's how we're coming over to market. So now that we have this here, okay, now what I'm doing is I'm going to pull over each one of these items that I went through and did over here. So this is my cost and this is my market. And now I'm ready to go through and do my analysis. So again, the way I'm going to go through and do this is I'm picking over here the middle values, and that is going through and then determining my market. So right over here, all of these items here, that's 24, this again is going to be the middle value. And over here, this 25 will be the middle value. Over here, this 9 is the middle value of these three items. And then lastly, we have this, I wish I had a mobile camera to show a cat eating a pencil. And then last right over here, we've got market being that replacement cost. Okay. So we're going to go now. I'm just going to pause this real quick. Okay. So now what we have to kind of go through and do is inventory at lower of cost of market. Okay. And if it is, basically we should say is cost greater than market. Okay. So this first one right here is the answer is yes. Therefore, I'm going to need an adjustment. Okay. Over here, nope, no adjustment needed. Here, I am going to need an adjustment. Over here, I'm also going to be needing an adjustment because over here, my cost is below. Oh no, over here, I'm fine because my cost in my market is above cost. So I do not need an adjustment for this. Sorry about that. Again, I'm trying to show inventory. Is my inventory being shown at the lower of cost or market? So here for the shores, basically my per unit cost is 18 and my market is 25. So I don't need an adjustment. Over here, I will need an adjustment because my market is below cost. And then lastly, I will also need an adjustment here because my market is also below cost. So the next thing I'm going to go through and do for this one right here is we're going to give ourselves a little bit more room. So I'm basically going here. So my adjustment is going to be, okay. So right over here, this is going to be my cost minus the market. Over here, I'm going to have an adjustment of $1. This is not applicable because my cost is below market. I'm fine. Here, 28 minus 24 is going to be $4. Here, this is not applicable. Don't need an adjustment. And then over here, I will need an adjustment of roughly $8. And then lastly, I'm going to need here an adjustment of $2. So how do I figure out the actual total amount of the adjustment? So right here, if I call my quantity units DDD, right here I've got DDD times CCC. So what I'm going to get here is 5,000 times 1, or $5,000, 120, 120, and 24. Okay, my total amount of my adjustment is 269,000. So again, where is the difference? And I really want to encourage you to watch that previous video, just because again, the only difference in intermediate accounting is how we're coming up with market. Okay, so my adjustment here is 269. So I know that my inventory is overstated by that amount. So now there's two different ways I can go through and do this. Now, when it comes to doing the adjustment in terms of the inventory, what it's going to depend upon is what is the materiality, meaning over here, my adjustment in terms of total cost of goods sold. So here in this first example, and this is letters A, B, and C, my total cost of goods sold is $50 million. So over here at 50 million, oh, need one more zero. Okay, so at 50 million, in terms of this being a percentage, when I take 269 divided by 50 million, I'm going to get less than 0.5%, right? Or roughly about 0.544%. This amount is immaterial, meaning that if I was an investor, it really wouldn't make a difference to me, okay? However, over here, so what I'm going to do when it comes to doing the journal entry is I'm going to make a debit over here to cost of goods sold. And again, I can do this because the amount is small relative to the cost of goods sold. And over here, I'm going to be crediting. And I have a couple different options here. I can do inventory or allowance to reduce inventory to market. This will be adjust inventory to the lower of cost of market. Okay, and so right over here. So that's what I'm going through and doing. So that's number A. This is like letter A right here. But now when it comes to B, this is a little bit different situation. What if cost of goods sold is $500,000? So my adjustment now is still at 269, but over here my cost of goods sold is 500,000. So as a percentage, this is significantly higher than what we were at before. So if I put this to cost of goods sold, I would be misleading my investors, because if I'm showing this as cost of goods sold, this isn't cost of goods sold. This is, I bought too much stuff, or I didn't manage my inventory well and the values dropped. So that's not cost of goods sold, that's bad management. So right over here, so instead what I'm going to do is I'm going to put over here, this is going to be loss due to inventory obsolescence. Same amounts, just different accounts. And here I can use the same inventory or allowance to reduce, actually we'd not credit inventory, I would call this allowance to reduce inventory to the lower cost market. Okay, so over here to adjust inventory lower cost or market. Now again, the explanation over here is kind of the same in the same video. Explain why. Well, here's quantitatively why you're choosing each one. As a percentage of cost of goods sold, it's immaterial here, it's material here. But why do we do it? You know, why? What is the reason? It all comes down to the investor. We do not want to be misleading our investors. It's extremely, it's extremely important for us to make sure that we're giving information to our investors, that the investors have the very best information that is basically that's accurate. So here I've got a cat, I'm about to have another cat attack, and then so I want to say goodbye. Excuse me. Thank you for joining me here today. My cat is now eating my computer. Thank you for watching. Please do not forget to like and subscribe, and send any kind of questions or comments to me at 1812cpa@gmail.com. Thanks so much.